If you're wondering how you'll ever save enough to pay for an expensive education, like private secondary school or an out-of-state university, there's a secret weapon you should know. It's called a 529 savings plan. These accounts were designed to encourage investing for future education expenses, helping you cut taxes and perhaps reduce the need for student loans. This podcast will review how 529 plans work, who can use them, and the tax benefits they offer. Plus, we'll review some brand new rules that make 529s more flexible for students and families. Welcome back to episode 951 of Money Girl. I really appreciate you being here and spending a little time with me. I'm Laura Adams, an award-winning author, an on-camera spokesperson, money speaker, and founder of The Money Stack. That's my Substack newsletter. Subscribers automatically receive my Money Success Toolkit, which includes the exact templates I use to manage my finances. So I would love for you to subscribe. You can learn more, ask questions, and sign up for The Money Stack at lauradadams.com. Another way to reach me is to leave a voice message with your question or comment by calling 302-364-0308. I'd love to feature your question on a Finance Friday, which is our weekly Q&A bonus edition of the show. All right, let's talk about how a 529 plan saves money. We're going to go through 9 ways that it helps you save money and cut education costs for yourself or students in your family. Number 1 is you can contribute just about any amount. A 529 plan owner is typically a parent or a grandparent, and the beneficiary is a child, and the child has no legal right to the funds in the account. So as the owner, you have control over the account. However, if you're an adult future student, you can open a 529 for yourself and name yourself as the beneficiary. You can also change the beneficiary to another eligible family member at any time. So maybe if you open it for one child, but that child ends up not needing the funds and you've got a different child, you can just transfer the beneficiary. States sponsor 529 plans, and each one has different rules about how much you can contribute. But you don't have to choose the plan for your home state or even where your student goes to college. Some plans allow you to contribute a total of over $500,000 per beneficiary. However, you shouldn't contribute more than the amount that's going to be necessary to pay for the beneficiary's qualified education expenses. And, I know you never really know exactly how much you'll need, but, you have to just do your best to guess and not go over by too much. Also, note that the IRS counts 529 contributions as gifts to the beneficiary. And for 2025, you can gift up to $19,000 per recipient. Or if you're a married couple and you file a joint tax return, you can double that and gift $38,000 without counting toward your lifetime gift tax exemption. And so this refers to the fact that you can give away about $14 million as an individual and nearly $28 million as a married couple before taxes are going to apply. So unless you have an ultra high net worth, contributing higher amounts than that $19,000 or $38,000 to a 529 plan in a given year won't have any negative consequences for your finances. However, you do typically need to report contributions above that annual gift limit to the IRS. Most 529 plans allow you to set up automatic contributions by scheduling a recurring transfer from your bank account on any schedule you like. Making small, regular contributions, just like you do with a retirement account, hopefully, that can make your education goal feel less daunting. And, over time, it can really add up to a massive amount. Or if you get a windfall, you can make a large 529 contribution at any time. So it's not like an IRA where you can only contribute $7,000 a year, $8,000 if you're over 50. There are much more generous contribution limits with 529 plans. All right, the second way these accounts save money is that you may be eligible for state tax deductions or credits. So most states offer at least one 529 plan. However, the fees and benefits vary, such as the maximum contribution limit and the investment options. And as I mentioned, you typically don't have to be a state resident to participate in its plan. For instance, you could live in New York, participate in a Florida 529 plan, and use the money to pay for a school in California or even overseas in some cases. However, some states with an income tax offer a tax deduction or a credit on your state tax return for residents who do choose an in-state 529 plan. That could add up to significant savings depending on where you live. So you really do need to just shop around and compare plans. The third way you save money is that you receive tax-free account growth. A 529 plan allows you to name and save for a future student known as the beneficiary, such as a child or even yourself, as I mentioned. After making contributions, you can choose investments from a menu, similar to how you would choose investments in a retirement account. And unlike a traditional retirement account, you do not receive an upfront tax benefit for 529 plan contributions. So you don't get that, upfront deduction. However, your earnings and your investment growth in a 529 are tax-free. That means you have more money to pay for education expenses. Number 4, you can receive gifts from others. A 529 offers unique gifting features that make the beneficiary more likely to have enough education funds. Anyone, such as relatives or friends, can contribute to a 529. For instance, a child's grandparents could add funds regularly over many years or even make a lump sum contribution, and that could be advantageous for their estate planning purposes. Number 5, you protect eligibility for federal financial aid. When qualifying for federal financial aid, parental assets are assessed at a lower rate than student assets. In other words, having higher balances in a parent-owned account, like a 529 plan, is better than a future student having a high balance in something like a custodial account or even a Roth IRA, anything in their name. So remember that student-owned funds count more toward the expected family contribution for financial aid, and a 529 beneficiary typically isn't the owner, as I mentioned. So that means having a 529 plan is an advantage for families and students who need financial aid to supplement savings because that account balance won't reduce their potential aid as much as other accounts. Number 6, you receive tax-free withdrawals. So in addition to that tax-free growth, your withdrawals from a 529 plan are never taxed at the federal and often state level if you spend them on qualified education expenses for the beneficiary. And I'll discuss more about those allowable expenses in a moment. Now, a 529 downside is that if you spend those funds on anything other than qualified education expenses, your account earnings are subject to taxes, plus a 10% penalty on top of that. There are exceptions, such as when the beneficiary receives a scholarship, veterans educational assistance, becomes disabled, or dies. Number 7, you have a range of qualified expenses. So there is a wide range of things that you can use these 529 funds on, including tuition and fees, room and board, books, supplies, required equipment, computers and technology, and special needs services. Plus, there are some new rules that allow you to spend a 529 on post-secondary credentialing and certificate programs like plumbing or cosmetology. Even for registered apprenticeships offered by trade or technical schools, licensing exams and fees to obtain or maintain a professional credential, and continuing education that's required for many professions. However, 529 funds cannot be used to pay for a student's extracurricular activities like sports or clubs. It can't pay for travel or transportation. You can't use it for health insurance or technology that's used primarily for entertainment. And if you're unsure if a fee is 529 qualified, check with your plan provider. Number 8, you can use 529 funds for younger students. Even though it's typically called a 529 college savings plan, it's not just for college anymore. You can spend funds on younger students, such as tuition for kindergarten all the way through high school at public, private, or religious schools. The 529 limit for secondary education is $10,000 per beneficiary per year. However, starting in 2026, you can spend twice that amount. You can spend up to $20,000 per beneficiary per year from the 529. Now, in addition to tuition, starting in July 2025, you can now spend 529 funds on more things for younger students. So these include learning materials and books, supplies, online tools, tutoring from qualified teachers, extracurricular programs, national test fees, and special education therapies for students with disabilities. And this isn't a complete list of all the things that you can use 529 funds for. So again, if you're unsure or just need more clarification, be sure to speak with your plan provider. Number 9, you can transfer unused 529 funds. There's no deadline or beneficiary age when you must empty a 529 account. If a child decides not to go to college, or maybe they just don't need all the funds that you've saved, you can transfer them to a new beneficiary in your family, as I mentioned, and that doesn't come with any taxes or penalty. As of 2024, another option for unused 529 funds is to roll over a certain amount to the beneficiary's Roth IRA. But this transfer comes with a bunch of rules, so let's go through those. The beneficiary must have earned income because that's what you need to qualify for a Roth IRA. So, if they're not working, they don't have any earned income, they're not going to qualify to have a Roth IRA. The 529 must have been open for at least 15 years before the rollover. The 529 contributions and their earnings made within the past 5 years can't be rolled over to a Roth IRA. The lifetime rollover limit is $35,000 per beneficiary, and the annual Roth IRA contribution limit always applies. And right now, that's $7,000 if you're under 50 and have that much earned income. So as you can tell, due to these restrictions, the Roth IRA rollover only benefits older working beneficiaries. However, it's still a good way to help them fund retirement instead of their education. Once you open a 529 plan, you want to set a goal to make regular contributions. Whether you contribute $10 or $1,000 a month, the sooner you get started, the easier it will be for you and your family to pay for education expenses. I hope those of you listening who have a 529 or will open a 529 will get to take advantage of some of the new rules that apply to these accounts. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank our amazing team. Steve Rickyberg audio engineers the show. Holly Hutchins is our director of podcast. Morgan Christensen is our advertising operations specialist, and Nathaniel Hoops is our marketing contractor.